thank you all for joining us today. Kyle Burns with the Raccoon Group, and we're really excited. We were very fortunate in the past. We've gotten to make some travels around the world, and in our previous travels, we got to go to Asia and China, and also Eastern Europe and the Ukraine. And this time, we're staying a little bit closer to home, or maybe a little further, depending on where we go. But we're going to take an exploration down to Latin America today as we kind of continue our journeys here. So with that, I'd like to introduce Nathan Chaudoin from American Century Investments. Nathan is a VP and Senior Client Portfolio Manager, and he's part of the Growth Equity Group and also works a lot on non-U.S. equity investment strategies. So with that, I'm going to pass it over to Nathan. As always, just housekeeping before I give it to Nathan, please feel free to ask questions as the conversation goes on. We welcome any and all questions. You can email those as well, or you can call anyone here in the office on the team. You can email them to info@raccoongroup.com if you have any questions. And with that, I'll pass it over to Nathan, who has a presentation to start us off, and then we'll move into the Q&A section. Thanks again, Nathan.
Yes, Kyle, thank you. I appreciate it. So yes, good afternoon, everyone. And yeah, certainly thank you for attending our presentation today. So again, as Kyle mentioned, my name is Nathan Chaudoin, and work on our emerging market equity product at American Century. I've been in the space now, 21, 22 years. So it's been an interesting ride over that period of time, much of which is involving Latin America. So we'll spend our time on that today. I'll share my screen with you now and just give you some idea in terms of the presentation that we have here. Get this in order here. And before we begin, I thought I'd give you just a quick introduction into American Century for those of you who may be unfamiliar with who we are as a company, as you can see here on slide 2. So we were founded in the 1950s in Kansas City, Missouri, and today we are a global asset management firm with over 200 billion in assets under supervision. And so, as you can see here in the chart, we are privately controlled and independent, and that our majority owner is the Stowers Institute of Medical Research, which is a biomedical research organization dedicated to uncovering treatments and prevention of many gene-based diseases, cancer, for example, diabetes. And as you can see here, it's through that unique ownership structure that we direct roughly 40% of our profits to the Stowers Institute. And so over the past 20 years, as you can see there, our dividend is totaling near close to $2 billion. So again, it's partners like yourself that make that possible. So again, thank you for being here today, and welcome to the call on Latin America. So I'll get into it now. Again, as Kyle mentioned, please feel free to ask some questions along the way. Welcome to interject and see where we go. So I think if you look at Wikipedia, right, the foremost source of information, is that you'll see roughly 21 countries listed in Latin America, about 620, 630 million inhabitants. Mexico, Colombia, Ecuador, Venezuela, Argentina, Chile. Now look, don't worry, we don't have enough time to go through 21 countries today in detail, but we'll spend the majority of our time on the commonalities across the region, across the asset, if you will, and with a particular focus on Brazil and Mexico. Again, two of the largest economies in that region there. And so I wanted to start here with just the performance of the region against global benchmarks. Okay, and what you'll notice here, which again, the line there in the yellow color is Mexico, you'll see that Latin America has performed very well over the last 3 years, which may be surprising to some. And so, when you put that in the context of, if you will, this kind of lost decade that saw a number of these economies across LATAM begin to stagnate, we're starting to see new optimism around certain areas in my markets, again, in the Latin American markets. So first, yes, it is uneven, right? And we'll discuss that, right? And it's also concentrated in a few countries, right? Particularly Mexico and Brazil, as we talked about. And it's also concentrated in a number of sectors: energy, agriculture, nearshoring, for example, in Mexico. So again, we'll talk about that. But again, the bottom line, what I think you should take away, is that things are beginning to improve. Okay, and what you'll see here, and as we'll speak through the presentation, is that 2023 will be the third consecutive year in which the consensus growth forecast have come in too low. Okay, so being revised higher over the course of the year for the last 3 years. And so you'll see the region is expected to go around 2.3% this year. And that will come in more than double the region's average over the last 5 years prior to COVID. Okay, so again, you can see the chart here, again, with the line, if you will, in orange and the line there kind of in the light green, that the bulk of the performance is driven by, again, LATAM's two largest economies, which is, again, Brazil and Mexico. And again, their strong performance explains much of the region's outperformance over this period. So we'll talk about exports here in a few minutes, but I also wanted to spend a minute on the resiliency of domestic demand in Latin America. And private consumption in particular is being held up by resilient labor markets, improving wages, and importantly, as you'll see in the presentation, we expect investment to make a comeback. Brazil, of course, but also too remains very strong in Mexico on account of the nearshoring, which I'll show you in just a minute. Okay. And finally, what you'll see is that, again, both of those economies, Brazil and Mexico, but also to Latin America as a whole, are generally supported by the global market's interest in this region's commodities. Okay, so it's very important. All right. So again, we'll demonstrate all that later in the presentation, but I think an important point to conclude upon, which will be the last slide in the deck that we show, is that slowing inflation across my region will allow central banks to either continue to cut rates, some already have begun, or to begin to start their monetary easing cycle. Okay. So what you can see here on slide 4 is simply the total exports and imports from Latin America over the last basically 23 or 24 years. It's growing, right? I talked about optimism and again a number of areas just a few seconds ago. I think what's interesting here is just to give you some points to take away is that if you look at all facts and figures just from this year, right? So very recent, is that in July, the European Commission announced investments worth of 48 billion over 5 years through Latin America, with a particular focus on green energy, hydrogen. In the same month, we saw Saudi Arabia announce 26 bilateral investment deals focused on mining and agriculture. China, as well, is making one of its largest strategic investments with $1.3 billion port, basically developing a port in Peru, which will reduce the shipping time between Asia and Latin America from 45 days to 35 days. Okay. And so, again, which is important, what you'll see in just a few minutes, is that a number of these countries in Latin America are taking advantage of its proximity to the United States, right? As you start to hear about companies bringing manufacturing closer to home, with either the pandemic or rising tensions between the US and China. Okay, so this trend of, and again, for those who can see me, I use air quotes like nearshoring, that has been maybe more lucrative than some have predicted. Mainly in Mexico. Now, not exclusively, but mainly in Mexico, where a term you may know of, FDI, which is foreign direct investment, it's up 40% this year, up 40. Okay, and again, we'll show you some conversation around that in just a minute. But again, just an example that this March, Tesla announced a 5 billion what they call gigafactory to help meet the goal of cutting manufacturing costs for its electric vehicles in half. Okay, so there's plenty of investment moving into this region, again, based on its proximity to that of the United States.
Nathan, can I ask a question on that?
Of
The
course,
last slide there?
of course,
definitely.
of course.
I was just curious, when we look at kind of trade rising there, how would this chart look in comparison to, say, other regions, right? Where if we're comparing this to, say, global trade in China or another emerging market, would this look different from those charts?
Yeah, so I think what we need to keep in mind, very good question, is that the nearshoring term had already begun before COVID, right? And you can see, kind of in the chart, kind of the slope of the line. I don't know if you can see my cursor on this, but the slope
in
of the
20
line,
where it
exactly.
accelerated.
There you go. Exactly right, Cal. But nonetheless, the trend, maybe the slope is not as steep, but the trend was moving in that direction prior to COVID. And so what you saw is that the basically COVID and the Biden's administration to largely expand the Trump administration's kind of anti-China policies, and move things closer to your friends, aka Mexico, that just represented an accelerator of the trend. Does that make sense? And
It
so
does.
from our perspective, and quite frankly, that's in the consensus, is that Mexico will likely be the main winner given its proximity to the United States, competitive labor cost, actually, which we have in here in the deck, with demographics, established manufacturing base. But I think to your question, there are other countries in EM that benefit. India, Indonesia, Malaysia will also benefit from that evolving terms of trade as again that nearshoring factor comes into play. Nearshoring or friendshoring, you may have heard that term as well, comes into play. And also too, again, with the cost of labor rising in China, GDP per capita rising in China, CFOs are looking to outsource that to other countries. Again, India, Indonesia, Malaysia will also begin to show some similar trends to your question.
Great. That's excellent. Thank you.
Sure. So if we look at Mexico for the sake of the conversation, so we put this slide together, and there's as you can see 10 or 12 little boxes there to show some of the kind of opportunities that we see for the space going forward. Is that there is plenty of upside for Mexico. As I mentioned with the slide just previous, or actually two ago with the performance, is that Mexico continues to surprise on the upside. And so with the fact that the U.S. has so far avoided a recession, that has certainly played an important role. But what we're seeing, as I mentioned, is that construction investment is now beginning to take the lead, right? That reflects two things: the acceleration in public works by the current administration, but it also reflects the effects of increased activity on account of nearshoring. Okay, again, you can see a number of points along the slide here. Mexico passed China in July of this year to become the United States' top trading partner for the first time in 20 years. Right? So underlying all this is the idea that at a time of rapidly shifting global trade, capital flows, Latin America has much of what the world needs, quite frankly. One is strategic commodities, two is renewable energy sources, right? And three is, of course, a skilled worker set, which is, again, very close to that of the United States. So if you were to look in 2012, the top US trading partners were in order China, Canada, Mexico. Today, that order is now Mexico, Canada, and China. Right? So Mexico has effectively taken the place, which I'll show you in just a minute, of China. Okay, so as you look at Mexico and kind of summarizing the chart that you see on my other screen, is that their structural drivers are in place. Okay, the world is regionalizing, if you will, and Mexico's proximity and link to the US renders it very well placed, again, Kyle, getting back to your question, to benefit from the sustained growth north of its border, right, in the US and certainly that of Canada as well. So again, more than 2/3 of Mexico's trade comes from or is with, if you will, the United States and Canada. Okay. So again, as it relates to growth in Mexico, the kind of upward revisions have largely come from investment. Again, more specifically, construction. Okay. So investment is already behaving better than expected. Again, largely due to the increased spending in equipment, manufacturing as well. But now it's, if you will, kicked into a higher gear to account for the strength of construction. Okay. So again, as I mentioned, it's partly coming from the public sector, right? Infrastructure spend, just as you see, for example, the United States. But again, it really reflects this kind of surge, if you will, in non-residential private construction. Again, which includes the industrial infrastructure that supports that we're still in the very early stages of this nearshoring activity in Mexico. Okay. So again, I think that's important. So sorry, Kyle, do you have a question?
No, yeah, sorry, I'll keep
Okay.
turning my video on and surprising you here
Gotcha. No, that's fine. Please, of
to
course.
jump in with questions. And maybe this is a good chance if we see your mini oil rig on your
Mhm.
card there in the middle of the slide. Something we talked about kind of in lead up to this call was thinking about, you know, how oil prices
Yeah.
impact kind of Mexico and the benefit, right? We're seeing on that slide that it shows they're the second largest supplier of foreign crude to
Right,
the US. And right now,
right.
obviously, we're dealing with, conflicts in Ukraine and the Middle East, which, have impact on oil supplies. So just curious if you want to stop at that point just for a minute
Sure.
while we're on the slide.
Of
And I,
course,
I
of
think I guess
course.
you have a natural resources slide as well, but
Yeah, exactly, but it's a great question. It's a good time to acknowledge it, and goes also too for the case of Brazil, which we'll see. So, Kyle, I think as we talked about, you're right in the lead up to this conversation today. We obviously have to acknowledge the humanitarian aspect of the situation between Israel and Gaza, right? So, acknowledging that, to your question around the oil price, again, Mexico and Brazil being an important part of that, we're seeing oil prices, the prospect for oil prices reaching $90 to $95. Okay. And that's fine. And that's supportive, obviously, of those exports from those economies. Okay. I think what you'll see is that if you start to see the regional conflict in the Middle East expanding in such a way that we see an impact to the energy infrastructure, which then leads to supply losses, and that pushes oil past $150 a barrel, that will push the US recession. How about this? That will push that might tip the US into recession, right? Not a given, we'll say for certain, right? But that could move the US into recession if we start to see $100 a barrel, $150 a barrel, excuse me, which would also at the same time push the US dollar to highs. So if the US were to go in recession, if oil was to reach $150 with expansion of the conflict, that would obviously have some downward pressure. I think that's where you're probably getting at with your question. There's some downward pressure just on the economic activity of Latin America for all the reasons that we just discussed: investment, proximity, et cetera, trade with the United States. So if the US moves into recession, you start to see some, if you will, headwinds to the prospects for growth in Latin America, or quite frankly, EM as a whole, but Latin America in particular.
great. Thank you.
Yeah, of course. So $150. Just watch for that. Short answer to your question. Watch for the 150 and whether or
I
not the
mean,
US goes into
it,
recession
it's
with
it's
that.
a it's a doubling from where we are now, so it's still
Exactly. So up
we'd
until
see
then,
a ways to go
exactly.
from now.
Exactly. So up until then, it actually does quite well for certain, you know, for certain companies in these markets that benefit from that, from the graphic that you just alluded to.
So I guess we had a question kind of come in here. It's a question of saying, so as we see that rising increase in energy prices, are we going to see, much more investment in, say, Mexico and Brazil based on kind of the where their energy reserves are at and opportunity there?
Yeah, I think that's a fair statement, right? That's a very fair statement and question is that, as I mentioned, if we were to summarize, Kyle, if you were to come on and say, Nathan, we have to cut the presentation to 2 minutes, not 30 minutes, give me your one bullet point takeaway. I would say that as that there's, the three things that I mentioned in my open remarks that LATAM has: strategic commodities, renewable energy, and skilled workers that are close to the United States. So to the question and the comment that just came in, those first two of the three align directly with that, right? So yes, I would expect continued investment in, again, the commodity space. Keep in mind the green energy side of that too, not just, if you will, the harder commodities such as the oil slide that we show here, but on the green energy side as well, whether it's lithium, hydrogen, areas that again support the transition to carbon neutral.
Great, thanks.
Sure. No, thank you. It's much more interesting to have interaction as we go through it. So I appreciate the questions as we go. So I think just to conclude the slide on Mexico is that I wanted to mention that this nearshoring phenomenon is still likely in its infancy, right? As more companies, and this kind of actually ties in with Kyle's question, as more companies begin to invest in Mexico. So far, it's been most of the foreign direct investment has been more so on the reinvestment of existing companies. Now we're starting, I mentioned Tesla earlier, we're starting to see new companies enter Mexico. Okay, so we continue to expect, again, going back to your question there you just posed, foreign investment in Mexico to rise sharply over the near term, right? Reinforcing overall investment, which again should provide Mexico with some cushion if the U.S. were to slow down. Now, not necessarily move in the recessionary, environment which we talked about earlier with the $150 for oil, but nonetheless, if the U.S. were to marginally slow next year, the investment in into Mexico should provide basically some cushion. Okay, so again, I think what we can look at here is that, and we'll transition to the next slide, is around moving from, if you will, investments, but also to acknowledging private consumption, which has also remained relatively robust and should contribute positively to growth going forward. Right, unemployment rates, are quite low. We're seeing formal job sector wage growth, contractual wage growth also remain quite strong. And what I wanted to show here is that the shift, if you will, in China's workforce, that is a very clear opportunity for Mexico, right? And so when you look here on the slide 6, is that manufacturing labor costs per hour in the U.S. Sorry, in U.S. dollars. In Mexico, it's roughly $3 an hour, right? In China now is approaching $7, roughly $7 an hour. Okay, and here on the slide here, you can see is that since 2009, the cost of manufacturing is, quite frankly, significantly cheaper in Mexico versus China. Okay, so again, what we're also seeing, which is very interesting, again tying back to the question that you just posed, Kyle, is that Mexico's imports from China, they continue to rise, which is suggesting that we're starting to see final assembly of products shift toward Mexico as well. Okay, so if we then switch countries and talk quickly about Brazil, much of the story that we just relayed, and particularly around commodities, as you can see here, quite frankly, is directly relevant to Brazil as well. And so, again, if you remember the first slide that I showed around the performance over the last 3 years, Brazil also continues surprising the upside and has done so again this year. I think what is different from the previous 3 years in Brazil is not due to higher expected investment, right? But because higher exports derived from exceptionally high agriculture production are driving growth this year. Again, you can see the trends over the last 20 years. And so LATAM as a whole is the world's largest net exporter of food. And Brazil's growth remains supported by its exports. Again, it's basically consolidated itself as one of the world's largest food producers. And here again on the slide, you can see is that we demonstrate here with a number of charts, basically the volume growth of several key commodities over the last decade. And keep in mind that is critical as the world's middle class is projected to double over the next 3 years, or sorry, 3 decades, 3 decades, to roughly 3 billion people. Okay, so they're going to need to eat. That's what we're getting at. And again, Brazil has a very important role to play in that as one of the world's largest food producers and subsequent exports, as you can see here on this slide. So slide 8 is effectively the last slide that I'll show today, and want to spend a few minutes on this slide because it's very important to our outlook. And then we talked about, again, growth being driven by investment and construction, so foreign investment into Brazil and certainly Mexico. We also talked about, again, the strength and robustness of domestic consumption. But also, too, what's important, again, what you can see here on slide 8, is that LATAM central banks have room to reduce their interest rates as inflation comes under control. Okay, and so what you'll notice on slide 8, this is again inflation, CPI prices over a number of our markets in LATAM, is that LATAM central banks were the early hikers. Okay, so on the inflation front, LATAM has showed gradual improvement over the course of this year. Okay, and of course the quest is to bring down inflation, and that's still a work in progress, as you can see here. But what you can see also is that the improvement has been tangible. Basically, there's meaningful progress made, right? Again, given the fact that they hiked quite early. So what you'll notice here in the chart is that after peaking at effectively multi-year highs during the second half of 2022, as you'll notice, headline inflation has been trending lower, as we see. And so if you kind of look by country here, is that Brazil has really been at the forefront of the inflation decline. Mexico continues to make progress, right? So from peak inflation in August of last year of about 8.7. Inflation is more than halved. It stands now about roughly what 4.3. And on the other side, though, by contrast, you'll see countries like Colombia, while making progress, if you will, they're still lagging in terms of their inflation expectations. Okay, but again, what's important to take from this slide is that given improving inflation dynamics, a number of central banks have already begun to reduce their policy restrictiveness. Brazil, Chile, Peru. Again, Colombia is expected to start in early 2024, Mexico in late Q1 of 2024 as well. So looking ahead, and then Kyle, I'll pause for a question. I say, looking ahead, the focus will remain on whether inflation continues its kind of post-COVID convergence, as you see, with the easing of the global supply chain, right? So other than Argentina, which I'll mention here in a minute, and I'm laughing because the numbers that I will relate to you are extraordinary, but nonetheless, other than Argentina, there is very clear and visible progress on the inflation front across LATAM this year, and we expect inflation to moderate further during the course of 2024. Kyle, let me stop there. I can see you're back on and see
No,
the question.
you're great. I was just curious, are there major differences in inflation for Latin American countries? Are they dealing with, say, persistent services inflation like the U.S. is
Yeah.
dealing with, or is it really sort of supply chain related? Is there something specific you could point to that maybe is different than what we experience here?
Not really, honestly.
Okay, no, that's
I mean,
great.
because your summation there about the difference between goods and services is spot on. Okay, it's spot on, in that services inflation is slightly higher in my markets, as you mentioned, just as in the United States, but kind of, if you will, converging back to norms post COVID, where goods inflation is still relatively, I'd say, reasonably under control. What I will say though is different. So acknowledging the goods and services comment that you made, there's similarities in my markets that we're discussing now. I think where there are some differences is the construction of the CPI basket. So what could make it spike, right? Is that you'll see again with the conflict in the Ukraine and the Middle East, we're seeing them minor, but could see sustained food and energy prices. And that, of course, given the weight of those two sectors, if you will, in the CPI baskets of LATAM, that could have some impact on inflation, if you will, going forward. So that is something that we need to watch,
Yeah,
right?
like as an
Again,
example, they could be dealing with grain shortages because of
there you go.
Ukraine or something like
There you
that.
go.
Okay. Yeah.
Exactly right. Exactly right. But again, the overarching theme that you mentioned around goods and service inflation, that scenario, if you will, phenomenon is exactly the same in my market. But again, I think to the latter part of your question, where there's differences is the composition of the CPI basket, and food and energy play a much greater role in EM, but in particular in Latin America.
Okay. Great.
So we've had a number of questions in my individual client meetings, for example, and maybe we'll have some more today around the expectations for the pace of rate cuts. And again, that ties in very clearly with the question that Kyle just asked, and that's a very fair question. Okay, and so I think it's a combination of several factors. One, it's whether or not the Fed remains somewhat hawkish and that higher for longer term that we've heard. And then two, as we just discussed, is the geopolitical impact of the ongoing situation, the ongoing conflicts in the Ukraine and Middle East, right? And how that impacts food energy prices. That may make LATAM central banks, I would say, more conservative when it comes to cutting rates. Not cancel, let's be fair, right? I think that's an important point, Kyle, for your clients to understand, is not to cancel, but simply more conservative in the pace at which they cut. Okay, so I think that's the point of caution, is that it may delay but not cancel the expected rate cuts in these markets, right? Because what you'll see is, and again, there's kind of history to serve as your guide, is that EM central banks are willing to kind of err on the side of prudent and sync their rate cuts with the United States, for example, a country like Mexico. Or for those that are easing now, the rate cycle could be shallower, if you will, and develop more slowly than what the market is pricing. Countries like Chile or Brazil, for example.
Right, well, there's a relationship with currency strength and
That's
interest
right.
rates, right? Which greatly kind of impacts. So I'd imagine those
Mhm.
decisions also factor that in, right? To say
That's right.
if we're reducing our rates faster in the U.S., that means the
Mhm.
U.S. currency would be getting stronger
That's right.
and our currency weakening in comparison to the U.S. dollar.
That's right. And so you're exactly right. Is that and you see I'm flipping back a slide for those on the call. Is that historically my markets, and again, there's still certain ones that are going through it, like Argentina, have to balance their currency and their inflation, okay, economic activity or not. And with this time around, my markets hiked rates, as I mentioned, much earlier and much more aggressive than the developed markets. So they were in a good spot, right? So thus far, my currencies kind of actually done pretty well this year because real rates have stayed higher. But also, two, is the fact that their exports are so large that does, particularly Brazil, provide some support for the BRL here over the course of this year. So even in the fact that Brazil is marginally reducing its interest rate, their currency is still supported again by higher real rates, but also to the fact that their export market is still quite large. But yeah, it's a very fair question, and that hence why I kind of made the comment earlier around central banks erring on the side of prudence and keeping their rate cuts in line with that of the U.S. Fed.
Mhm. But it appears they'll still have some ability to ease
That's right.
rates going forward. Yeah.
Absolutely, absolutely. And again, that's crucial to our outlook. And quite frankly, we can bring this to a conclusion with that. Is that you know we've talked a lot of good, right? And I think it's fair to balance the risk that we see in these markets. I mean, Latin America, EM as a whole, of course, is not without its own risk, and active management plays an incredibly important role in assessing let's say, the specific opportunities of these markets. I mentioned Argentina earlier, and that government is going to be forced with some very tough economic adjustments in its bid to reduce inflation, right? It's currently running, and again, I checked the numbers at 138%. It's the highest level since 1991. Okay, so on an annualized basis, it's running at 246% over the last 3 months. And so that should push inflation over 200% by the end of this year. Okay, 200, right? And so it's quite high, obviously.
Well, if
Chile,
we think, oh, I was just gonna say, if we
no,
think of
please.
Argentina and their what is basically hyperinflation, I would think at this point, right, is that if we look at them at like how interconnected are all these countries and how much would moves in Argentina impact to Brazil, if little
Yeah.
maybe or not so much.
Yeah. So historically, again, I'll again use air quotes for those contagion risk across LATAM has been more political than inflationary. But you may then respond, well, Nathan, well, isn't inflation sometimes largely driven by politics and decisions by the central bank, whether they're independent, the populism of the governments, et cetera? So you're right if you were to think that, and I can see you nod your head, so you're probably in the same line. So what I said earlier is that the incoming government, the Argentines have an election soon, they're going to have to face some very tough decisions. So I think what you'll see, Kyle, to your question, is that contagion is somewhat limited now that the stability of Mexico, of Brazil, even here, even Chile and Colombia are going through some very aggressive policy agendas, reform of the constitution, et cetera, to stabilize their political dynamics, right? Because they want that foreign investment. Okay. And so
Mhm.
I think this is that the the external context for LATAM has improved, quite frankly, on a variety of fronts, and that's overcoming some of the more specific headwinds, such as the political situation and inflationary situation in Argentina. Okay, so I think the contagion, short answer, is more limited than it had been in the past. Again, given the fact that, for example, countries like Mexico are heavily dependent on nearshoring or Brazil on exports, rather than interconnectivity amongst their own basically their own countries within the region. And the fact, again, that there's somewhat more stability seen across the economic agendas of the recently elected politicians. Right? Brazil had one. Actually, Mexico
Mhm.
also has another one coming as well.
Yeah. We had a question come in here.
Yeah.
Something we talk a lot about in the U.S. is this kind of green energy transition,
Hmm.
and I think for the majority of our investors, or maybe not, maybe I'm wrong, but we don't necessarily think about what's going on with green energy investment in Latin America
Yeah.
specifically, right? And so maybe if you could just talk a little bit more about that and kind of the trends you're seeing there.
So thus far, the trends I would say have been more supportive of developed markets, or even the case of China, which is still an emerging market, reach their transition to net zero. So using commodities in LATAM for other countries' carbon carbon transition goals. Okay. So I think the question, if I understood correctly, is what's LATAM doing themselves about this transition?
I think so,
And
yes.
thus far, they're well behind. Okay, so short answer to the question posed is they're well behind and have plenty of room to also begin their own transition because they have ample resource to do it towards green energy. Okay. Also, not just even green energy, but they also have abundancy of minerals like lithium, for example, to support the transition to a net zero carbon economy. Okay. So thus far, it's been more supportive of other countries, but what you're going to start to see is investment themselves spurring that transition. They're lagging, short answer,
Hmm.
and we
Yeah.
should begin to see that happen over the near term.
Did it, would it mean opportunity, you think, or is it a ways down the road when we look at that, right? Like
Yeah.
I know with emerging economies, right, their goal is to move on from being emerging and then
Hmm.
eventually once you've passed being emerging, then you get to
Right.
say, okay, now we're making the tougher decisions like
Sure.
running on cleaner energy.
Right.
Um, I guess that would be the case here, right? Is to
Yeah,
say
that's right. That's right.
we need to raise our middle class, and then we'll start to make these decisions.
That's right. And again, I think what you'll get back to is the drivers of GDP growth: domestic demand, domestic consumption, foreign direct investment, and also two, if you will, local investment. And the third will spur the conversation that you just had there is that, again, there's ample room for these economies and, quite frankly, government policies to support the transition to cleaner energy at a much faster rate through investment in these markets.
Yep. So when we look at say major companies, right,
Mhm.
that move into Mexico that have sort of, green ideals, we'll call them.
Right.
So when we look at those companies, it probably doesn't really accelerate those actions, right? Because those
Right.
companies are moving there for less expensive labor, probably fewer regulations.
That's right.
Uh, yeah.
That's
Okay.
right. I mean, Tesla is the great example of that,
Hmm.
right? So I gave the example in our opening remarks of roughly, it's a $5 billion investment in, again, this kind of giga factory that they're going to make, and that's supportive, of course, is reducing the carbon footprint, the energy transmission, et cetera. But it's more for, if you will, the cars that go into Tesla, which are then sold in other markets,
Hmm.
right?
Yeah.
So does that make sense? That's what I was trying to bring in the conversation earlier. Is that, you know Tesla wants to cut its manufacturing cost in half, right, for electric vehicles, obviously. So that's supportive of the global transition, but it's not necessarily supportive of Mexico's transition, right? So I think that's the
Yeah.
nuance of the conversation in question that you're bringing up here.
So maybe if we shift gears a little here and
Sure.
we think about a potential recession, kind of a
Hmm.
global type of recession, which many predicted for this year, and now many are predicting for next year or
Yeah.
starting to back off on. How does a global recession really impact the region? Can they operate on their own, or are they really reliant on the major economies like U.S. and Europe?
Yeah.
Mexico, Latin America. I don't want to just
Yeah.
limit us to Mexico, but
Sure.
can they
Sure.
decouple from the rest of the world when it comes to a recession?
Yeah. So I think, the answer is very straightforward, is that there will be a global slowdown next year. So that's fine. Is it a hard landing or is it a soft landing? And if it's a soft landing, we're in good shape. Emerging markets as a whole, but also to particular LATAM. So to answer your question, no, LATAM cannot completely decouple from a global slowdown. Okay. But at the same time, we don't expect a collapse in activity either. Right? Domestic demand that we talked about, that will provide some cushioning to a kind of worsening external backdrop, right? Because labor markets are still very robust. We still have a very strong pickup in private investment, for example. Nearshoring continues in Mexico. So I think what you'll see is that the consensus, right, street, began to revise GDP expectations lower for the region next year from this year, but again, not a complete collapse in activity. Right. So
Hmm.
watch hard landing versus soft landing. If it's a slow landing or soft landing, excuse me, we'll continue to move along at the pace for those three areas I just discussed.
I do really like the confidence there, saying there will be a global slowdown next year. So that's
Yeah,
I'm
I think,
glad.
yeah, I
No,
think, I mean, when you look at the restrictiveness of the Fed and quite frankly, monetary policy as a whole, not just the Fed, that has to start to trickle down into consumer confidence, labor markets, et cetera. Right. So again, whether or not the Fed can engineer the soft landing versus the hard landing, I think that's still the question du jour. And that will have very important implications for risk assets as a whole, but obviously my markets in EM.
hmm so if we kind of turn that around and we continue to see the resiliency in the U.S., avoiding recession or heading towards that soft landing scenario,
Right.
uh, what would big slowdowns in Latin America mean for other countries?
Yeah.
Developed
So
markets.
yeah, right. So if we're kind of flip it around, I mean, again, I think it has to deal with obviously the hard landing versus soft landing, because whether it's the $150 per barrel of oil that we talked about earlier, pushing the U.S. into recession, the kind of conclusion with that would be obviously, you know, have a downward impact, negative impact on LATAM. I think the same could be true then as well, is that we would have to watch the pace of investment, right, in Latin American markets that we just discussed, if the US were to land too hard, right? But also, too, at the same time, will the demand for exports remain so strong if you will, interest rate policy has to remain restrictive globally? So there is interconnectivity for sure, getting back to the question, between the opportunities in LATAM, whether it's across other emerging markets or particularly into the developed markets like the United States and Canada, and whether or not those economies, if you will, land softly or land hardly, will have an impact, direct impact on again the outcome for LATAM for sure, for sure.
Mhm. Okay, interesting. So we're pushing about 45 minutes in here. We want to keep everyone engaged a little, but so maybe just we'll have a little fun and wrap
Sure.
up probably in the next 5 minutes or so. But so obviously you have a Latin America focus in your research, but if you're looking out at the broader kind of EM landscape, what are your sort of favorite markets? Obviously, that's not being investment advice, but
Yeah.
opportunity wise, is it really Mexico with those kind of the metrics we're seeing, or is it
Mhm.
Brazil, population wise, or exports, right? Where do you really see, like, maybe it's India? India was real
Yeah.
popular as a conversation this year. I don't know. Do you have a
Sure.
favorite?
Sure. I mean, look, you know, it's like your children. You don't have favorites, right? It's like you like these markets for the specifics that they bring. Every market is incredibly diverse across EM. So you're right, first of all, is that, with this slide here, actually, that we still have on the screen, with room for central banks to ease in LATAM, that will directly be supportive of the outlook. So we see opportunities for EM next year, 2024, EM as a whole. And as I mentioned, we could, quite frankly, see opportunities in LATAM as we've discussed. But as you broaden out your question, is that, yeah, I mean, we see evidence of goods and improving basically on the production side, the trade side, in tech products, for example, bottoming out across Asia, which should support regional growth. So, like, for example, if you look at export data, similar to what I showed earlier for Brazil, but if you look at it for Korea, which is often used as kind of a bellwether for global trade, it continues to surprise to the upside as well, right? So there's just further evidence that the global export weakness that's beginning to bottom, if you will, right? So I think, if you look at the Asian markets in particular, rising semiconductor prices, that's going to support exports and basically the overall tech cycle shows some signs of restocking. Outside of Asia, you're right. We're quite constructive on India. There's a number of tailwinds as it relates to labor force growth, very similar to what we discussed actually with Mexico. They're also going through important regulatory tax reforms to, again, to attract foreign business, very much like what we discussed with Mexico. Supply chain diversification and such. And I think also too, what's interesting about India is that they're largely domestic driven at this point, which does provide them some defensiveness in the event that the global growth does slow down next year. Middle East, actually, with obviously acknowledging the current conflict, but countries like Saudi Arabia continue to go through very important structural reform. Thailand continues to benefit from improving tourism. So what I'm getting at, Kyle, is again, I don't want to belabor the point, but
Hmm.
that there are very specific micro opportunities in every country that we look at. And so, holistically, or even specifically by country, one may look more attractive than the other. But again, from a bottom up perspective, you can still find some opportunities that are kind of independent from the top down macro, right? So again, I think the active management approach in the space is very interesting to the question that you just relayed.
I think that's why we look for teams like yours to help us out, because I know you guys have a full staff working on these questions, and
That's right.
we try our best here at the Raccoon Group to know about it, but it becomes pretty extensive when we get kind of on the ground. I know uh, in our lead up to this, Nathan was saying that you used to visit around 17 countries a year. Is that
That's
correct?
right.
And now
That's right.
I know since COVID it's slimmed down a little bit, but certainly getting that real perspective by getting to travel to all these
Yeah,
places is really important. So
absolutely.
we appreciate that. But I think with that, we'll open for a last question if there is one, and if not, I know I have a question. I'm going to follow up with you via email. So
Okay.
uh,
With pleasure.
hopefully you're ready for that. But anyone on the call that didn't get their questions answered, or when you hang up you may come up with a new question, feel free to send us an email here, and we'll reach out to the team at American Century to hopefully get a good answer for you on your questions that you have after this presentation. But with that, Nathan, I really just want to thank you for your time. Thank
Of
you to
course, Kyle.
American
Thank you.
Century and the team there for all you guys do to kind of support our business. And we look forward to continuing the conversation, and we'll take it from there. But again, thank you.
Absolutely. Thank you all. Thank
Thanks,
you.
everyone.